Well, thank you all for coming. It's great to see such a room full of people, a big room. Back in the day when crowdfunding started, we didn't get this kind of turnout. And in that regard, before getting to our panel, I really do, I want to thank the people who made this possible. And in particular, I want to thank three people who have already been thanked, sort of, but I want to do my bit. Doug Elinoff, who has left the room. Doug Elinoff spearheaded, the Jobs Act and deserves just a huge amount of credit. I want to thank Richard Swart, who may have also left the room. Richard is sort of if people don't know this already, the world thinks of Richard Swart as the leading academic in the crowdfunding industry. And he's been there from the beginning, and it is always an honor to speak from the same podium that Richard has spoken at. And finally, one of my panelists today, Sam Guzik, immediately to my right, spearheaded Regulation A, or so-called Title IV. We would not have Title IV without Sam. And just an incredible amount of labor, meeting repeatedly with the SEC, trying to push the thing forward. I always say that Sam is the father of Title IV, and Mary Jo White is the mother. So if you want to think about that for a second.
Oh, dear Lord. That's upsetting.
All right. So just a couple comments before I let the panelists introduce themselves. Just a couple sort of random comments. Crowdfunding and social media. This is a random comment, but it's related to the previous panel. In my view, crowdfunding is the intersection of finance and modern social media. I just can't emphasize that too much. Those two things go together hand in hand. And with Title III, I think just absolutely, if you can get social media, you can get Title III investors. And there's a lot to say about that. Maybe some of our panelists or some of our audience will want to talk about that. And secondly, a related point, I always say that fortunately for Sam and Doug and me and other lawyers, fortunately, crowdfunding has a lot of very complicated legal rules, and you can get in a huge amount of trouble if you don't follow them, fortunately, because that means you have to hire us. But crowdfunding is not a legal business. Crowdfunding is not a finance business. Crowdfunding is not a technology business. Crowdfunding is a marketing business. I say that 12 times a day. Crowdfunding is a marketing business. And the success of Elio Motors and some other offerings is sort of an illustration of how it can be done, how the marketing can be done right. And so marketing is the future. The guys, the gals who can market crowdfunding most effectively are going to be those who find the greatest success. And so, Sydney, when you're looking for sponsors for your next presentation, it's the marketing guys, right? Okay, so, well, actually, let me just have the audience briefly introduce themselves. All of us on this panel, right, we talk to each other all the time. We're on these panels all the time. And so we can have a good conversation among ourselves. I was sort of thinking, everyone in this room has been sitting here so nice and quietly for the last 2.5 hours. Maybe there are a lot of questions that people would like to start asking. So I'd sort of like to give people in the room, if they would like to, an opportunity to ask questions and maybe have less panel and more audience. Can you raise your hand if there's a question you've just been burning to ask, so I can get a sense of, okay, not too much burning to ask questions, just a few. Okay, well, we will make sure we get your questions answered. Okay, Sam, would you please introduce yourself?
Yes, hi. Sam Guzik. I'm a corporate and securities lawyer. I've been doing this for 37 plus years. Wore many hats, started out at a major firm in New York, international law firm, took different paths. I now have, since 20 years plus now, my own firm down in Los Angeles. I feel mostly on the issuer side, smaller issuers that want to go public, that do become referred to as micro-cap or mini-cap. That's kind of been my sweet spot. And that's one of the reasons why I've been so engaged in these new types of finance options since the Jobs Act. I'm right at home here. I went to a junior college right up the street, got my law degree at a place called Leyland Stanford Junior University. Also feel right at home because this is my second conference with Sidney Armani, and I want to thank him for hosting these conferences. So we're here to hopefully educate you people today about Reg A+, and I'm going to use a different word than crowdfunding. I think we're really talking about internet finance, and that's where we are, and that's where the financial markets are going. Thank you.
Hi, my name's Jillian Sidoti. I have not been practicing for 37 plus years like Sam, but I am 37 plus years old. I won't tell you how much more over the plus. But I'm from syndicationlawyers.com. We specialize in securities transactions, PPMs, Regulation A's. I've been doing Regulation A offerings since 2008, and I am incredibly grateful for Sam's work with the SEC on Title IV, because if any of you out there that are lawyers or issuers that have tried a Regulation A prior to the Jobs Act, I will tell you this, and this is a true story. It's the one and only time I ever cried over the phone at the SEC. I recovered, but I'm not sure the SEC attorney did. So anyhow, I do want to say I do have a book coming out next week on Amazon called The Crowdfunding Myth. And go out, get it, write a nice review. Thanks.
My name's John Frutkin. I, was involved, as kind of a lot of lawyers were, on the super sidelines in 2012, and pontificating to various clients and other people about what the Jobs Act would mean to them. And in 2013, after I had surgery, it was January 3rd, I was all drugged up and decided to write a book called Equity Crowdfunding. And what's actually interesting about that is that when we do these panels, we had one panel which was we should change the name of equity crowdfunding because it doesn't resonate with people. They don't know what we're talking about, which might be a topic that we want to talk about. But we can't do that because my book's called Equity Crowdfunding. And so the kind of backstory, though, is that in writing that book in particular, it's called Equity Crowdfunding, but it's just, the subtitle is transforming customers into loyal owners. And really what I've been speaking about and what we're seeing discussed, because the Title III and the crowdfunding, just not obviously we're not able to use it quite yet, but it's just kind of lumbered along. But it's the concept that it's for more than for startup companies. It's really a way to engage your customers in a way that you can never do that before. And so I was lucky enough to write that, which has given me an opportunity to hang out with most of the people on the panel. I recognize that something that we do in these conferences is that we stack the great marketing people and then we stack all the lawyers. And so our collective goal, and I think where Mark was going with this, is to prevent us from referring to things by names of titles and focus a little bit more on the stuff that might be a little bit interesting about where the market is going. As lawyers, we're a little bit lucky to have all the secrets because we know what people are going to do next. So if you ask the question the right way, we might just tell you some of the stuff that we're seeing kind of emerge in 2016. And I do think that we are seeing kind of a different type of issuer than probably we're talking to most of us 2 or 3 years ago. And so a lot of the credit goes to the people here. So with that.
My name is Marty Tate. I am a corporate finance securities lawyer. Also do not have 37 years of practice, but I am grateful for those that do. There was the SEC release of numbers last week, which Doug referenced earlier and Richard referenced. One interesting note is that 1/3 of the Reg A filings, they said, came out of California. I think that's partly because of these two here. So, so it's a pleasure to be serving with them. Just to address a point that Ron brought up earlier, he talked about the getting a call and there was somebody represented by somebody in Denver. I don't know where that puts Salt Lake City in your mind, but we have some smart minds there as well. And I was introduced to crowdfunding in about 2010. I had a client approach me that they wanted to do peer-to-peer lending, and this was their model. They wanted to do peer-to-peer payday lending. Really interesting idea. They had a platform called YadYap, which is payday spelled backwards. I think they still have a splash page there. But the Jobs Act was just it was just an idea at that point. So we went through the process of trying to figure out how to, following the Prosper and Lending Club model, how would we do that? And along came the Jobs Act. I met Richard Schwartz and his this group of innovators that was back in Washington, D.C., got involved with them, and Richard really brought me into crowdfunding and have had a chance to speak with him at a number of things. But just a large part of my practice has been focused on funds. I was general counsel and a managing director of a company called Harbor Capital. We had about $500 million in real estate funds that we managed. That was in 2007, 2008. I don't know if I should proudly say this, but I was the last one there. I shut the doors. But I learned a lot. And we learned a lot, and it's been very helpful because now I advise a large part of my clients are real estate funds still, and I'm active in helping them form those funds, raise money. And
Okay, that is our panel of esteemed lawyers, and they are. I mean, they are the tops in the field. One, this is not really a plug, but I have the sense that there are a lot of people in this room who know more about crowdfunding than any of us do. And on the other hand, there are people in the room who are brand new to it. If you were to go to I have a blog, and if you were to go to my blog, which the best way, it has a couple names, but it's markroderick.net. Right on the front page, there's a link for something I call the crowdfunding cheat sheet. And it is a table that shows the different kinds of crowdfunding and the basic rules that apply to each kind. So most people new to the industry sort of find that useful. It has an interesting history. I posted it, I did it for myself just so I could keep track, posted it on my blog. It just went all around the world, and I was at a conference in Texas with a developer who said he had been holding it in his hand. He was in a meeting with George W. Bush trying to raise money from the Bush family for a big real estate project, and George said, "What's that?" And he showed him my cheat sheet, and the upshot was George wasn't interested in the details. So that is a true statement.
just so you know, it looks like this. I had it in my pocket.
Yeah, there you go. There you go. Okay, so you wanted to ask a question right in the beginning. Do you have a pressing question you'd like to ask? Because I'd like to take it if you'd like to ask it.
What role does the panel see in the importance of valuation and deal structure evolving over the next 2-3 years for success of an offering?
You should probably repeat it. Just 'cause
I
there's no
think
mic.
that was directed to you, Jonathan.
Oh, well, I'll repeat the question at least.
Okay.
The question is, how do we see an evolution with respect to deal structure valuation and kind of the stuff that maybe lawyers live in that world? And because I get to answer it first, I'm going to say that I think that deal structure and valuation and some metrics like that are going to become less and less important, and I'll tell you why. I really believe that more and more of what is happening in our space is being driven by kind of exciting innovation and or customer relationship with the issuer. So whoever it is who's giving it out is actually a little bit more important probably than some of the metrics that we look at when we're dealing with funds, institutional investors, and others. But that puts a lot of potential pressure, obviously, on the issuers who want to make the valuation $1 billion and then have a deal structure that's extraordinarily favorable to them. And so we are going to see this kind of evolution, I believe, where that becomes a little bit less important. There's a flattening of the variance because we see so many different deals and different deal structures in the world. And then I come here and you know, there's so many Series A's and B's that we do up here, and I see it's just like easy breezy. You know, it's like easy to do a deal here compared to a lot of the deals that I see in New York. I see in the East generally, even in the Midwest. They're different. They're easier up here, and the reason is because there's been kind of a learning curve where the funds have learned that it's easier. Instead of negotiating everything to death, it's easier and quicker to push through technologies and to get volume and to get flow through so that you're not spending a ton of transaction time on every single deal. And so I see that happening in our space. That's my view. In the next couple of years, you're going to start seeing that start to standardize. I think a lot of the people in the room here have our own little different ideas, but then we go home and we're like, yeah, Sam was right. And do how Sam does, copy everybody's stuff. So we're fortunate enough that we know each other. So I do see that happening pretty quickly.
Okay.
That's right.
Do you want to say something about that,
Yeah,
Sam?
a couple of things. First of all, on valuation, I think we're going to see a market improvement on valuation, particularly for companies raising capital, which for me, that's what it's all about. That's what makes things go, is the companies that, let's use Reg A+. These companies that we're going to see, I think, successful are companies that typically couldn't get to an IPO, or at least not until a much later stage. Number one, and number two, so they were really limited to private channels of capital. And the reality is you're not going to get the same valuation in a private placement than you're going to than a Reg A+ offering. And that's pretty simple and straightforward. With Reg A+, you're getting liquid securities. With private placement, no matter how it's marketed, you don't know if and when you're going to have an exit, and so there's definitely a discount for liquidity, and if your alternative is going up the street to Sand Hill Road versus what Elio did, which is they said, forget the private equity, you're not going to be dealing with things like ratchet down anti-dilution provisions where the initial valuations don't mean anything. And in Reg A+, as has been said in a lot of different ways already today, it really is, it's not about the lawyers, it's about marketing. Marketing before the offering gets filed, during the offering, and once it's live. And by having a broader exposure, that's broader market demand, that's what pushes valuations higher. So in that sense, just briefly on structure, the structures of the securities aren't going to change significantly. I don't see any reason why they will. But the structure in terms of the way deals are sold will change. We'll see some deals sold without underwriters. We'll see deals sold with underwriters on a best efforts basis where it doesn't go to an existing network of institutional investors. It's going to go primarily to retail investors, and it's going to be, you're going to see a much broader retail participation, what people like to refer to as democratization of investment. Thanks.
You want to say something, Marty?
Yeah, I was just going to add, I was going to agree with Sam that I think that you're seeing, outside of, just what Jonathan said, I think is true, that there are deals, maybe deals get done a lot easier here in Silicon Valley than they would in other places. And what I'm seeing is you're seeing people with great technologies, great companies, ready to go, trying to raise capital that just can't find that venture capital money, at least on the terms that they would like. Like Sam says, they're negotiating terms that are difficult to swallow, that are now coming and saying, hey, tell me about this Reg A plus, what could we do there? What could we do on a 506C? I actually try to steer them towards Reg A plus as well, so I think that's an interesting evolution. It's providing another option, and I think with that you'll see better valuations. You'll see more capital raised, and hopefully, better companies coming out of it.
Thank you for that question, and feel free, anyone else, to raise your hand and ask questions. I'm going to switch topics a little. As you know, if you've looked at the crowdfunding cheat sheet, or you already know, there's a big divide in crowdfunding as between if you're selling to accredited versus non-accredited investors. And the reason is that since the inception of the U.S. securities laws back in the 1930s, the principle has been rich people can take care of themselves. They're smarter, they can hire expensive lawyers and accountants and investment bankers. They don't need the government's help, whereas ordinary people, who I was at a conference in the Midwest, called those people ordinary, hardworking Americans, and in New York they called them the great unwashed masses. But those people need the government's arm around their shoulder, and I don't say that sarcastically, because there is some intuitive sense about that, and it's actually worked extremely well. The U.S., within that framework, has the best, most transparent, most active capital markets in the world by far. So that's why there's this difference between accredited and non-accredited investors. When you bring in non-accredited, you have to jump through a whole bunch of extra hoops. So I'm going to ask Jillian to start off. Why in the world would anyone raising money want to raise it from non-accredited investors? Why not just raise it from accredited investors? Simpler, faster, easier. Why deal with the world of non-accredited investors?
Okay, I think I'll use my own hometown as an example. I live in a place called Temecula, California, which is Southern California wine country. We like to think we're the Napa of the South. Napa would disagree. But reality, what we have in Temecula is some accredited investors. We have some very wealthy people there. And then we have this huge swath of people who make well over $100,000 a year, but not quite $200,000, who have a net worth of over $500,000, but not quite $1 million. These are good, smart people who have nice checkbooks.
Hardworking Americans.
Hardworking Americans, come on now.
Yeah.
And honestly, a big part of it is for a lot of my clients, they come to me and they say, hey, I want to do an offering. And I say, okay, you can only take accredited investors. And they say, but what about my Uncle Joe? My Uncle Joe has always supported me. He's not accredited. How am I going to take his money? Well, under 506C, you cannot. So, I mean, Regulation A is really, I have about 7 going right now. Most of them are in the real estate space. A couple are in a couple other different spaces, but the intent of every single one of them is very, very clear. It's not, I want to raise gobs and gobs of capital. They can do that with 506C. It's that I want to be able to go out to my loyal list and offer them the opportunity. I want to be able to go out to my friends, families, and associates in my, I'll use like Kansas City, Missouri as an example, or Kansas City, Kansas as an example. I want to go out to those people who are not necessarily accredited, but that's my hometown, and I want to be able to give them the opportunity to invest. And
Okay,
and
so Jillian has, her answer is mainly because non-accredited investors actually have money, right? They don't have as much, but there are a lot more of them, and they have capital. Mm-hmm. So, Jonathan, are there any reasons other than the availability of more capital that you would want to bring in non-accredited investors?
Yeah, because you don't put brakes and transmission shops in the rich part of town. And what I mean by that It was funny because I got brakes and transmission client. I said, why are you in all these neighborhoods? He goes, because rich people go and get a new car when their brakes and transmission go out, or they're under warranty. Fact of the matter is that for a lot of issuers, their brand is enhanced by having those same people who otherwise would be their customers to become owners of the company. And so you get an
Because not all customers are accredited investors.
Well, it turns out that it depends who's inventing the statistic at any given moment. But there's some number between 88 and something like 94% of people are not accredited, right? I mean, so the number is extraordinarily high. The fact of the matter is that you are receiving some sort of relationship in exchange for the money, and so that's a driver. And now on the flip side, we talk about institutional investors. You know, venture firms and other stuff bring certain expertise to a company, and so maybe somebody's giving something up by not going that route, more than valuations. But the bottom line is that you're getting something in exchange for dealing with the extra overhead of non-accredited investors.
All right. Sam, do you want to add something to that?
Yeah, sure. I mean, if you're dealing with institutions, they're only concerned with two things, ROI and liquidity. When you're dealing with retail investors, they come in lots of shapes and sizes. Jill has touched on a good one because we see this from companies coming to us in the real estate area and elsewhere. People say, look, I've been doing this for years, whatever it is, syndication, whatever. I've got all these accredited investors, but gee, if I use Reg A Plus, now I can go to people who I know want to invest but can't. And so there's this whole ready pool of capital. That's one area. Lots of other reasons to do it. Fundrise, a company that was using Reg A before the Jobs Act, and probably in a lot of respects, sorry they did. They did local real estate projects, and the reason they used Reg A is they wanted local unaccredited investors in community projects so the community would support the project. So at the end of the day, 90% of their money came from accredited investors, 10% came from non-accredited, but that money was important not because of the money, but because they were able to get local community support. Other areas, if you want to put stock in the hands of your customers, your distributors, these are generally going to be mostly non-accredited people. Reg A Plus provides a way to do that. A traditional IPO does, but by the time you get to the size of Google or Facebook, it doesn't matter. So we now have an avenue for companies that are maybe pre-revenue or post-revenue who need that exposure and can benefit by it to really benefit their business. And so that's an accelerant by making these unaccredited investors and ambassadors for the company.
Yeah, and a couple other examples. Well, the heart of crowdfunding, okay, most of us sort of think of it as a finance tool. There are people who don't think of it that way at all. People think of it as a community development pool, a community development mechanism. So if you think about, if you're a biotech company, for example, and you think you have invented a therapy for cystic fibrosis, which happens to have touched me personally, and it's touched, unfortunately, millions of other folks, tragic disease for which there is no cure. So you're a company that thinks it has a cystic fibrosis therapy. Today, for the first time in history, because of the Jobs Act, you can market to everyone who has been touched by cystic fibrosis. They're not all accredited investors. So you get the ability to engage in these affinity marketing campaigns. Sort of on a less serious note, in my neighborhood, there's a microbrewery that's about to open. Well, besides having been touched by cystic fibrosis, I've been touched by beer. And I would love to invest in that company. And before, you know, they could not have marketed to non-accredited investors. But the key here, it's not just money, okay? Think of the cystic fibrosis or the beer example. If you're marketing a therapy to cystic fibrosis families, let's call it, you are likely to get feedback from those families. They're the ones who have experienced it. Okay, you're going to get feedback about what helps and what doesn't help. what therapies they would like and what therapies they wouldn't care for as much. The magic of crowdfunding is the symbiosis between the investor and the issuer. Okay, Marty, I'm going to ask, yes, sir, do you want to ask a question? No? You just raise your hand? Yeah. I do that too. Just raise my hand every now and again. Yes, sir.
Sorry, I'm quite new to crowdfunding. I've fortunately had experience.
And they let you in? You're new and they let you in? Sydney, come on.
Hey, a fair amount of experience in venture capital and running a public company and all that stuff. But now, as an investor and an entrepreneur, I'm looking to potentially crowdfund a company around scholars. And the question is, how do you assure, return on investment to your investor, and with the liquidity, source of liquidity? I heard secondary markets and so on, but what has been the experience in crowdfunding of people who have funded, not equity, but the non-equity version of it? How have they finally received any return? What's the source of which they get liquidity?
Do you want to answer that, Jillian?
Yeah. So a lot of my clients, I have a couple of different ways you could address that, but a couple of my clients, what they do is it's not obviously there's no guarantee of anything in securities, but they do a preferred return, and they say, look, we're gonna give you at least X on your money before we do anything else, just like you would with any private placement memorandum or anything like that. So they start with that basis and then maybe do some kind of equity waterfall on the back end where they distribute additional profits after the fact. And I would say, because I do so much work in the real estate space, most of my clients use that model. So they'll say, we're giving you a 6, 7, 8, 9%, whatever it is, return on investment. Yeah.
So, sir, we're going to give you some incredibly free legal advice here. But what exactly would your crowdfunding model for scholars look like? What does that mean? Are you investing in, helping people pay for their education and then taking a return based on a percentage of their income or something like that? Or do you not want to tell us?
We're creating a community and housing for visiting scholars.
Okay.
If you go around campuses, Berkeley or Stanford and so on, the real challenge visiting scholars have is not being able to find decent
Okay.
housing for short periods of time and having a sense of community around that campus for the few months that they're there.
Sounds like a real estate deal. I'll talk to you later. No, I'm just
Yeah, no, it is a real estate deal. So, Marty, do you want to
Yeah.
tell him what the typical real estate deal is and what titles he should be looking at?
And with that, I think it depends. Obviously there's so many questions, but the size of the raise, if you're trying to do, if it's a $10 million raise, maybe maybe a Reg A offering would work, but perhaps you would use a 506C offering. And one of the things that, it's similar to what Jillian was saying, is another option is doing even a convertible debt. You could do a convertible debt offering where they're coming in, they're saying, great, we want to see how this, and this, I see this more in operating companies where they say, great, we're going to come in, we're in a secured position. However, if we like how the project's going, we see that there's going to be tremendous upside, then we can convert that to equity. Like I said, that tends to be more favorable in operating companies, whereas in a real estate holding company, something like Jillian referenced would be, I think would work great.
Yeah, and we should say probably 90%, 95% of crowdfunding by volume is real estate, still, so far. Sam, could you,
Yeah.
I'm not sure what you were
No,
going to say, but
I just want to
can
add
you-
something about, because you touched on real estate and liquidity, and I'm seeing some things out there which are not necessarily intuitive, and I'm curious if Jill is seeing some of the same thing. One of the big features about Regulation A+ is liquidity. Of course, another feature is you can go out to unaccredited investors, you can raise up to $50 million in a year. What I'm seeing on the real estate side is people coming to me and saying, and even the non-real estate side, that's great, you know, we can do our offering, we can list on OTC Markets, but frankly, we don't want our securities to trade, particularly in the real estate area, because if you look at the experience of REITs, publicly traded REITs, they don't trade very well. And your typical investor in a syndication isn't looking to just buy and flip their equity. They're going to hold for longer term to get the economic benefits of the real estate investment. So liquidity in the real estate area is a little different, and it's also surprising and counterintuitive for lots of companies. Another example is a company that's been doing private placements for years. They say, hey, I don't really want my securities to trade right away in Reg A plus until I can get a really vibrant, active market. Why? Because I've got all these investors out there for years holding their shares, and they're going to want to sell. So everything is not intuitive. There is a long learning curve here, and we've just really all started the process of learning.
Well, Sam's been doing it for 37 years. But Sam, can you talk about, in the existing market, in crowdfunding real estate, the differences, the prevalence, or how often you see debt versus equity, and why equity has become, by far, the preferred vehicle?
I'm sorry, why?
Why debt has become so much more popular than equity, if that is your experience.
Right. Well, I mean, that touches on another point. How do I satisfy my investors? And what we are seeing in Regulation A+ transactions is not an offering of equity, but just straight notes. And I'll let Jillian speak, because she's a dirt lawyer as much as a securities lawyer. I don't mean dirty lawyer, dirt lawyer.
That means a real estate lawyer, folks.
It's not a pejorative term, it's a term of endearment. So I'll defer to Jillian on that.
So, you know, there's a lot of crowdfunding platforms out there that do the payer-dependent notes that are dependent on the particular property. Those will not go through on a Regulation A+ unless you name the specific properties, which for a house flipping type of, we saw it with ground floor. If any of you are familiar with ground floor, they put a Regulation A offering in, and the Regulation A offering went in, and I know what happened. You don't see this happening, but I can predict what happened. They got what's referred to as a bed bug letter that said, pursuant to Rule 415, you can't do it this way. So you either have to identify the assets or do something else. And so they identified 3 assets for their Regulation A on what are called project-dependent notes. So those projects independently had notes attached to them, and you can invest in those individual notes. But the SEC is not going to let an offering like that go through without those assets in place. Doesn't make sense for a single-family flipping fund. It simply does not. So again, most of my clients are just using a preferred return model, so they get the same result as equity in the sense that the investor understands that they're getting a stated return, but it's not debt, it's equity. And that's what I'm seeing. I do have a couple of unsecured notes offerings, but other than that, I'm seeing preferred return models more than the debt offerings, because under Rule 415, you just can't get the project-dependent notes through.
Okay, now debt, someone asked the question earlier, what about liquidity? Which is, liquidity, we would all agree, is the holy grail in the crowdfunding world. That's the one thing we can't offer yet. But if you think about a debt, a note, you know, I'm going to pay you back with interest over 5 years, it's a self-liquidating asset. So it provides investors a built-in liquidity that they don't get with straight equity investments. Jonathan, someone comes to you and says, I want to raise $40 million. No, they say, I want to raise $15 million. $15 million. I want to include non-accredited investors, and I am sure that all of my investors will come from only 5 states. Do you tell them?
I'm sorry.
Do you tell them, you know what? If you do tier 1 of Title IV, you won't have to do audited financial statements. So let's go through a five-state review process. Is that what you tell them?
So that was like this like law school exam question. It was funny because as he changed the question, I was like, I got it. Let me make a little bit of a leap from the ground floor conversation because this has to do with this new coordinated review process. In other words,
what does that mean?
You can instead, for these larger offerings up to $50 million, go to the SEC to review everything and stamp off on it. You could have these 5 states stamp off on it. Now, there's a bunch of advantages.
Can you just tell the audience the difference in what we're talking about between
Yeah.
Tier 1 and Tier 2?
It's basically that we had this old Reg A that Jillian and 2 other people did. You know, it's like a very rare thing where you could go to the states and the state securities administrators would tell you what you could include and not include. It was very inefficient if you were looking at raising money from multiple states for a billion reasons, including the fact that some states are incredibly hard and some states are incredibly easy. And so as part of this process, and Sam knows all the inside baseball about this, we decided that we would steal Reg A and change it from this thing that went state by state, and we'd lop on top of it, and then it would be nationalized, basically. And we would have an easier way for us to go ahead and raise money. And instead of $5 million, we'd boost it to $50 million. And a funny thing happened on the way to the ball, which is the state securities administrators went, no, that's our stuff, like, stop. And so the inside baseball is, we said, okay, we'll have this new idea, which is a Tier 1 and a Tier 2 offering. Tier 1, up to $20 million, you go through the states. Tier 2, up to $50 million, you go through the feds. And so we did this kind of crazy conglomeration. And so the state securities administrators, in a desperate attempt to stop Sam and others, said, you know what we should do? We should have what we call coordinated review. We'll have one state take the lead. That way, you'll have this great opportunity to avoid having to, go through all these different states, get all the advantages of not having to do various compliance things, and you can do it that way. And quite frankly, most of us said, oh, we will never, ever, ever, ever do that, ever.
When will we do it?
Now, it turns out, the ground floor, and some others have decided to go through the coordinated review process. I don't know if anybody here has. I mean, as from where I sit, it's just too uncertain how that works quite yet. You have very different politics, obviously, with different states, and I'm not comfortable with it. So, maybe you have a better experience in a description, but that is something that some have chosen to do, but we're early in the data. And I haven't, because I'm scared of things.
I think Jillian's going to tell us some horror stories.
Coordinated review is smoke and mirrors. They had coordinated review prior to the Jobs Act, and it was the biggest joke. You're supposed to send everything to Pennsylvania. Only a couple, about 20 states participated in it, and it didn't, like, the coordinated review doesn't mean that each state doesn't have their own opinion. They still have their own opinion, and they all vary. So I would send something to California, and California would be like, okay, go with God, you're good. But then I'd send something to Texas where they say, well, we've kind of got our own rules here, and you need to capitalize your company with $1 million of your own money before we even let you go forward. We're raising $5 million. So here's what happens when somebody comes to me and says, I would like to do a Tier 1 under Regulation A. And I go, here's Sam's number, because I'm not doing that. So yeah, essentially, to me, Craig from CrowdFund CPA is sitting right there. You can call him and get your audit and pay $2,500, or you can cry yourself to sleep every night doing a Tier 1. The choice is yours.
Wow, what a plug. That was fantastic.
The other issue with that is just timing, because each one of those states is going to take a different period of time. Like Jillian said, somebody might just rubber stamp it and say, you're good, and another state might be 10 times harder than the SEC would ever be. So you just never know. And I know, for example, in another area of regulation, going through multiple states of regulation, you have some states that are absolute nightmares, and you've got one person with stacks of paper in their office, and they're trying to get to your offering behind, 200 others. So.
Sam?
Yeah, for everyone's benefit, the difference today between Tier 1 and Tier 2, without going through the history, Tier 2 is what people call Regulation A+. That allows you to sell up to $50 million through a registration process. Regulation A, the original regulation was now transformed into what's Tier 1, bumped from 5 to 20 million. It has certain advantages, it has certain difficulties. The difficulties is you get state-by-state review. If you're in the wrong state that has merit review and the wrong kind of company, you're not getting through. So that adds expense, uncertainty, and maybe even fatal to your offering, depending upon the type of company, because of what's referred to as merit review. Now, what Tier 1 does have to offer is, instead of audited financials, you only need reviewed financials. And with Tier 2, Reg A+, which is for, I think it's a positive for outside investors, you have ongoing reporting, so there's transparency. Whereas with Tier 1, there is no ongoing reporting whatsoever. So there is no transparency. And so I think where you're going to see the Tier 1 projects are more local, community-based. If you have a company that lives in the right state where you don't have a difficult regulator, and they don't care about a trading market, for example, like in real estate deals, then it could make some sense. But my default position, and everyone on this panel, is I have an offering now. They only want to go in 4 or 5 states initially. It's Reg A+, because you just don't want to deal with the states, and that's why we've had Reg A since 1936, and it's hardly been used. So.
Okay. Let me ask a question. Hold on, because this is important. At the beginning, I think Richard was talking about minority participation in crowdfunding, and how, of course, somehow, I say that, a little sarcastically, but, crowdfunding, although we have a pretty good mix in this room, so that's a good sign. Crowdfunding so far, again, has become predominantly a white male business, a white male industry. I do actually have a number of minority clients, including one that I just filed a Regulation A offering for. I've seen some minority participation interested in using Title III for inner city urban development. But let me ask the panel, what do you think the industry needs to do to encourage women and minorities to become involved in this industry? Jillian, you want to?
I really think it's just a matter of, really getting people involved. It goes right back to marketing. Marketing to investors. I was talking to somebody the other day, and I was saying, I just finished my book, and now I can relax. And she said, what's the book on? And I said, it's on crowdfunding. And she said, what's that? And I said, GoFundMe. Kickstarter, anything? No, just to try to explain what it was. So I think part of the problem is that people, generally speaking, just don't even know. I'll use a different example. I was talking to my aunt, who is in her mid-60s and getting ready to retire, and she was complaining to me about how her 401k is always, going haywire, and she's very nervous about retiring. And I said to her, you should get into some crowdfunding deals. And I think that's a whole new audience of people that could, diversify their portfolio.
Now, I'm interested. Okay, you said to her, you should get in some crowdfunding deals. And she probably said to you, how do I go about doing that? Or which ones?
I'll tell you what I recommended.
How did you answer? Yes, how did you answer her?
I recommended Fundrise. I said you should go check out Fundrise, because they've been such an industry leader in terms of getting things out there. They have the e-REIT out there. I wasn't necessarily recommending the e-REIT itself, but I recommended her checking out some projects on Fundrise and seeing how it worked. And when I said to her, you can make about 8% on your money, she almost fell on the floor and died right there, because she couldn't believe that you could make 8% on your money.
Okay, now, that is an incredibly interesting story. Going back to the marketing question, because what did she recommend for her aunt, who presumably she likes?
She's like my mom, so yeah.
She recommended Fundrise. Fundrise has established a brand name, okay? Fundrise has successfully marketed themselves and established a brand. So investors follow that brand name. I would give and do give people exactly the same advice. There are a handful of portals, but if you're thinking, how am I going to be successful in this business? The marketing, that brand identity, just hugely, in other words, no one goes to Fundrise because, they have the best legal documents, because they don't.
No,
but they go because of that brand. It's about marketing. Sam?
Okay, it's not often I have an opportunity to correct Mark, but this is one. To the extent that we're Regulation A+ as part of crowdfunding, in fact, I think history reflects that the first Regulation A+ testing the waters campaign was by a black-owned business entertainment business that's centered on reaching a national black audience. They were, in fact, the first company to do a Reg A+ testing the waters campaign. I actually wrote an article about this, and the reason I did was because their campaign launched on June 11th of 2015, and the new regulation didn't go into effect until June 19th of 2015, and I think they read my article and decided to pull the campaign. A few months later, they filed with the SEC. I don't think they're going to go far just because they don't have the right advisor. So, this is something that's really colorblind, and it's a question of education and outreach, and that's going to happen over time. It's not, there's no color or ethnic filters here.
Right, and there are great opportunities for affinity marketing. I represent people who do loans within the Indian community, for example. I know of a company doing loans within the Muslim community. I have spoken recently about to a black guy who wants to market to a black community. So these are definitely opportunities, and we'd certainly like to see it go further. Marty.
Yeah, just to that point, I have a client who is a Muslim. They're a Muslim portal. It's Sharia compliant investments, which is interesting.
Wow, now that is cool. Can you tell us what that means exactly? It sounds
so
pretty cool.
There's just, and I didn't know this. I'm not an expert on Sharia law, but there's a whole religion-based standards on investments under Islam that have to be complied with when making investments, and so they're launching a crowdfunding portal that will be compliant with that. But I was actually going to say, I digress. I was going to say that I think under Title III, as has been mentioned here, I think you'll see more communities being involved. I think you'll see more of a less hey, I want to make this part of my bigger investment portfolio. I think you'll see these projects where they'll be community-based, where people will say, I know that business, I like that business, I want to get behind it. And you'll really be able to, and Title III will become, or Regulation CF will be the tool that will allow them to raise those funds.
And do you think investors going into those deals, do you think they have the same, what do you think their expectations are? Do you think they're just looking to make money? Or
I think it's partly I think they might have the thought that I'm going to make money, but I think there's also going to be this sort of social impact that they're going to make. I sit on a board of the Community Foundation of Utah, and where we manage a fund and we make social impact investments or decide where those investments go. And every one of these companies I look at and said, this would be a great company for a crowdfunding campaign. They already have community support. They already have people that want to get behind them. Their only option at that point is, hey, we can go out and raise money. And a lot of people are willing to write checks, but how great would that be, say, here, I'll write you a $10,000 check, and I also know that when you become profitable, maybe I might get something back.
Ron Miller, you just sold $18 million of Elio Car Company. Elio has obviously marketed itself as more than a car. It's a social movement, it's empowerment, it's changing the face of transportation. Do you think all those 6,500 investors, not speaking for all of them, but did they invest for the financial reward down the road? Did they invest because they wanted to be part of a social movement? Do you have any sense from having spoken to investors, what the motivation is?
So, yes, thank you for that. And the gentleman that was asking questions earlier, I sort of wanted to chime in on that one. But here's my belief, is that I think that 80% of the motivation of why people invest in a crowdfunding campaign is because they believe in the vision of why it's going to make the world a better place, and they believe in the founder's ability to pull it off. That's the reason they invest. It's less about 20% about a financial return. No one who invests in a crowdfunding campaign wants to see themselves ending up like the Oculus Rift people did, right? Where they invested, for those of you that are not familiar, this was a VR headset, raised about $2.2 million, sold it very short time later.
On Kickstarter.
On Kickstarter, right.
Donation-based. You didn't get
That's
stock.
right.
You got a T-shirt.
That's right. And so after people, well, they were supposed to get the product. It hadn't even shipped yet. Facebook bought it for $2.2 billion. And these people said, well, where's my 100X on my $400 investment? And the answer is, you're not getting anything. And it wasn't Kickstarter's fault, and it certainly wasn't the Oculus people's fault. It was, really the SEC's fault for delaying Title III, which, right? And I'll just put the blame right where I think it belongs. But
I can't believe I gave you the opportunity to say that.
well, you did. You teed me up, and I just, you threw me
got
the
it.
lob, and I hit it. But I do think, and I think that, by the way, that there is also running behind it. I'm a little surprised by the demographics of the audience in the room here today, skewing much older again than I would have expected.
Well, thanks, Ron.
Yes, you're welcome.
I'm
That was
only
for
37 plus.
Yes, that's right. Didn't include you. But actually, the millennial demographic is much more interested in why their investment is going to make the world a better place. That's driving the investment.
Yeah.
And not so much for the financial return. I look at it as the 80-20. Now, I'm a baby boomer.
Yeah, and
80%
so
of the
it's-
reason I invest is because I got to satisfy my wife, who only wants to know two things: how much are we making and when we get it, right? That's all she asks. Now, that's 80% of the investment decision. 20% is because I think this company is going to do something great. But that's not the motivator. So I think that's a real difference here, at least at the early stage of crowdfunding. I hope that down the road, what happens is that we begin to see companies that are going up there because they're offering a return and because investors are seeking the return. I think that'll be more at a stasis once we see some maturity in the market.
Okay, and now let me turn the question on its head. Jonathan, I'm sorry, Sydney, 5 minutes. Okay, I'm going to ask maybe one or two questions to the panel and then take some more questions. How does this, we are all enthusiastic and high-minded and all that stuff, and everything Ron just said, which is, I think, how most of us in the industry think about the future of the industry. How do we avoid turning into a pink sheet industry? In other words, we've got all these Regulation A deals out there, and people start to sell them, to do hard sales. We start seeing very high commissions. How do we keep that from happening, or is it possible to keep that from happening?
Well, going to our very first question of this session, there's kind of a natural flow of this. And one of the things we talked about in the middle was that we are seeing more deals. Again, I understand in the real estate space, but I'm pulling them where they're preferred return deals. I have in my deals, I have redemption rights for a certain percent of these private deals that the company will repurchase a small percentage each year if somebody wants to sell back. Like all these things we're kind of working through collectively as a group. And I think ultimately the bottom line is something else that we mentioned, which is a lot of this is driven by kind of this socialization, right? Elio and Pebble Watch and all these giant ones are complete anomalies. There's a lot of reasons why they raise a lot of money. They're different, okay? But for the most part, you're talking about people raising money for real estate projects. You're talking about people raising money for operating businesses in relatively small amounts. And the key really is that these are people they know or have a relationship with. And what we are doing is we are taking a technology, we're taking an opportunity for people to do this more efficiently and for people to do the things that we were just talking about, make a difference, et cetera. And how we avoid it is basically the bottom line is you put together the parameters and people will get used to the fact that some investments cash, others don't. But if nothing else, the ones that are successful will be the ones that people continue to invest in, the same management, the same, the same industry. And so it's going to work itself out over a relatively short period of time, in my view, and other people's view, a longer period of time. But we'll avoid all that because people are generally investing in stuff they know. In the pink sheets, people were investing in things that they were being pumped.
Okay. Sam, I'm going to let you have the last word on that. As truly the father of Regulation A, I'm sure you would be more disappointed than anybody else if it deteriorated.
If you could repeat the question,
Yeah, we're checking your phone. Yeah, how do we in the industry keep particularly Regulation A plus from deteriorating into a sort of pink sheet world of shady operators and nominal securities and expensive middlemen? Is there any way to do that?
Yeah, well, I don't think it's going to happen.
Why?
For a number of different reasons. One, if you look at specifically Regulation A+, the SEC loves it, and the reason they love it is because it's an SEC reviewed process. You have to go through their portals. They don't review the investment to see if it's good or bad, but they want to be sure that everything's disclosed. You need audited financials. And because today we're moving to securities being marketed online on the internet, there's so much more information available. And if, for example, Ron Miller knows this better than anything else about Elio. There was so many information, misinformation, opinions, chat rooms, Reddit, you name it, all over the place. So somebody who is interested in investing, they had lots of opinions out there, good and bad. Some were bogus, somebody probably competitors that are trying to sabotage them, fired employees. There's so much information out there. The other thing is the regulators are watching. The SEC in particular, the states don't really tend to focus on things till they get a phone call, a complaint. The SEC regulators are watching. It's a new market. They want to be sure that fraudulent practices don't develop. The people who are really driving this industry that are involved with the infrastructure, whether it's securities attorneys or other people like Start Engine or Fund America, we want to be sure that we don't have any problems. We don't want to have any companies involved that have problems because that's going to be a negative reflection on the industry. And when you have something new that's under scrutiny and you have the naysayers out there, you want to lead with your best foot. And if you smell any problems of fraud or anything like you're going to go the other way. So there's going to be self-policing, regulation, and a lot of transparency because of the internet.
Great answer. Okay, I'm going to take one or two questions, and then Sydney's going to make a stop. Yes, sir. Can you speak up or wait for the microphone?
Sure. States are recently, I think, taking advantage of the Title III passing crowdfunding acts for intrastate trading, and I'd like to know what your opinions are on how those intrastate portals will fit into the bigger landscape here.
That's a great question. So for those who don't know, while Title III was in its gestation, the states, a number of them, how many, 25 states, something like that, came up with their own crowdfunding laws that as long as you only had investors from that state, you could raise money from non-accredited investors. A whole bunch of other rules too, but that was the idea. So the question is, if I can rephrase it, is state intrastate crowdfunding still viable now that we have Title III? Is that a fair way to ask your question? Jillian.
So in California specifically, crowdfundings actually are always existed. They have this great thing in California called registration by permit. So you can go to the state and say, I want to sell securities in the state, and it's exempt under Rule 147, so long as, of course, you stay in the state and all your investors in the state. Great for real estate companies that are California-based.
Are there any limits about how much you can raise?
You can
or
raise
anything?
as much money as you want. So quite frankly, it's better than Reg CF if you can do it, if it makes sense for your
And
business
by Reg
model.
CF, she means Title III.
Sorry.
I'm just trying to
And
translate. I'm the anger translator here.
I appreciate it. So if you want to check out a crowdfunding platform that operates under this model, one of my clients is collectivesun.com. It's collectivesun.com. They raise money for for nonprofits to put solar panels on their buildings. And quite frankly, we started down the path of we should do a Reg A. This was before Jobs was complete. This was back in 2012. So we started down the path of Reg A, and I said to my client, this isn't going to go through because of Rule 415. It's project-dependent notes again. So we went to the state of California. We got a permit. They can raise up to $20 million for projects in California from investors in California, and that's how they started their crowdfunding platform. Interestingly enough, though, on their website, you will not see the word crowdfunding at all. One of the caveats of getting our permit was that we were not allowed to use the word crowdfunding.
That's interesting.
Yeah.
Marty, what do you think?
Yeah, and I think that to give the classic lawyer answer, it depends. I think that in some states you have the same limitation. It's $1 million limitation. And so in those states, I'm not sure why you would limit yourself to just one state. Say, for example, and I don't know, I can't think of the state that has $1 million limitation right off.
New Jersey does,
New Jersey,
as
there
an
you go.
example.
So New Jersey, so why would you limit your offering to just New Jersey when you could expand it? And I hear there's a little bit of money across the river that you probably could take advantage of. So, but there might be, that being said, there might be a certain circumstance where you say, I don't want to have to file, I don't want to have to use an intermediary, I don't want to have to file a Form C, and I know that I'm going to raise all my money within this state from these, this group of people. It might make sense then.
Yeah, I know Michigan was a state that had early on enacted an intrastate rule, and as of very recently, after count up all the totals of all the deals that had been done under that law, it was still zero. So it just had not been used very much.
Yeah, just a couple of thoughts on intrastate crowdfunding. There's over 25 states that adopted statutes largely in response to the inaction of the SEC to promulgate rules. We now have rules. I think we will see, limited utility of intrastate crowdfunding. Some of them, for example, are as high as Georgia. The reason we haven't seen much use yet, really two reasons. One is people aren't aware of it because the people who are going to use it are probably, they're the least sophisticated in terms of capital raising, and this is brand new. The other is really a problem courtesy of the SEC. Most of these statutes go under a federal exemption, which requires that to take advantage of it, you cannot offer the securities out of state. Well, the SEC, despite a number of past rulings, when it came to crowdfunding in the internet, said, wait a minute, you can't use internet solicitation because that's an offer and it's going to go outside the state. So basically, the whole point of crowdfunding is expose your deal on the internet, and if you can't expose it generally on the internet, that's a problem. That's going to change. The SEC got it. They have some proposed rule changes now to fix that and to broaden that. So hopefully that'll change. And just one last word on California. Does not have crowdfunding intrastate. What Jillian's talking about is a little more complicated process where there have been 3 bills. This is the third year now where a crowdfunding bill has been introduced in California. The first 2 times it was shot down. Why? Because it was lobbied against heavily. By whom? Ironically, in your light of your remarks, but not surprisingly, payday lenders who live off of small people trying to get things started in their garage off their paychecks. It's not the consumer groups. It's not the investor protection groups. There was a bill just introduced a couple of weeks ago. I don't have time to comment on it now, but California just does not get it. Eventually they will, but they don't.
Okay,
yeah.
we're going to stop. We're going to have lunch. Let me just say one thing. Crowdfunding is the internet coming to the capital formation business. I forgot to say that earlier. That's all it is. But when you think about what the internet does when it comes to industries is, whether with Uber or Amazon or anything else, think about that when you're thinking about your future in crowdfunding. I want to thank our panelists. Fantastic. Thank you very much.